Today, when good news is bad news and people run for the hills. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and property news with a distinctively Australian flavour. Well, we live in very weird times because we again saw data that showed positive economic activity driving considerable falls in the market. And in fact, stock investors that have turned too optimistic about the economic outlook are setting up for disappointment, according to JP Morgan. They said it may be too early to say a recession is off the table following the Federal Reserve's aggressive hiking campaign, especially since monetary policy impact on the economy can have a lag of 1 to 2 years. The central bank is likely to pivot only in response to a much more negative macroeconomic backdrop than markets are currently expecting, they said. Historically, equities do not typically bottom before the Fed is advanced with cutting, and we never saw a low before the Fed has even stopped hiking, they said. The damage has been done and the fallout is likely still ahead of us. While global equities have rallied this year as hopes for a Fed pivot, China's reopening and Europe's easing energy crisis provided support, there are signs for those who want to see them that inflation remains a persistent problem in the US, which will weigh on markets. And we continue to get commentary from hawkish Fed officials, which have sparked fears that US rates could peak higher than previously expected. The first quarter is likely to mark the high point for stocks this year, said JPM, who turned cautious on the outlook for stocks towards the end of last year, while remaining positive for much of 2022. They expect the rally to fade amid warning signs from key monetary indicators, such as the heavily inverted yield curve and money supply moving lower in Europe and the US. JP Morgan strategists are not alone in their pessimistic outlook. Morgan Stanley's Michael Wilson ranked number 1 in last year's institutional investor survey when he correctly predicted the sell-off in stocks, said the bear market rally has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming, in a note on Sunday. And last week, Bank of America corporate strategists, led by Michael Hownett, said the delayed arrival of a US recession will weigh on stocks in the second half of the year. And on Monday, Citigroup said that they wouldn't chase the MSCI All-Country World Index higher, as it's already trading at the top end of their target range. And they also said that most contrarian trades that call for selling last year's winners and buying the losers are set to fizzle out, adding that they favour oil stocks to tech, which has soared so far in 2023. And with a May and March hike nearly priced in, the odds of a June hike increased to 59% compared with 50% last week. A June hike would actually lift rates beyond what the Fed previously projected in December. Investors will look to the Fed minutes due on Wednesday for further insights into the central bank's thinking on monetary policy measures. The S&P Global Purchasing Manufacturers Index showed that business activity in the United States rebounded to its highest level in 8 months in February to 50.2 from 46.8 in January, buoyed by a robust services sector, according to the survey. The report adds to a recent slew of economic data, which has painted a picture of a resilient economy, which continues to perform against a backdrop of multiple rate rises by the central bank in 2022, aimed at tamping down inflation. With inflation still far from the Fed's 2% target and the economy retaining much of its vigour, money market participants have been revising upwards where they see the Fed funds rate peaking, currently at 5.35% in July, and staying near those levels throughout the year. This business activity data doesn't do anything to get rid of the fears that the Fed might be more hawkish and might feel like taking rates higher than what investors were thinking just a month ago, said Brian Jacobson, senior investment analyst at Allspring Global Investments. US stocks had an upbeat start to the year after their worst annual showing in more than a decade in 2022, as investors hoped the central bank's rate hike cycle was nearing its end. With this positive mindset driving indices higher, it makes equity markets susceptible to pullbacks when data undermines expectations of what the Fed might do. And so the Wall Street benchmark index tumbled on Tuesday, weighed by mega-cap names after data showed that rebound in business activity in February, and that stoked fears that the US Federal Reserve might need to hike interest rates by more than expected to control inflation. The Dow Jones Industrial Average fell 2.06% to 33,130. The S&P 500 lost 2% to 3,997, and the Nasdaq Composite dropped 2.5% to 11,492. The Fear Index rose 7.72% to 22.87, while the DXY rose 0.33% to 104.20. All of the major 11 S&P 500 sectors fell, with the Consumer Discretionary Index down 3%, leading the way. Among those hit this Tuesday were the big tech stocks, with Tesla, Amazon, Microsoft, and Google parent Alphabet all falling between 2.1 and 3.9%. After being an exception to Tuesday's big tech woes during the morning, Meta Platforms also slipped, and the Facebook parent had initially been buoyed by confirmation it was testing a monthly subscription service called Meta Verified, which will let users verify their accounts using a government ID and get a blue badge. Elsewhere, Home Depot slumped 6.3% to a 3-month low after it reported fourth quarter results that missed on the bottom line and guided for 2023 earnings a share to decline by a mid-single-digit percentage, compared with Wall Street expectations for flat earnings. In its post-earnings call, the home improvement retailer said it expected a moderation in home improvement demand amid heightened inflation and rising interest rates, a tight labour market, and moderating equity and housing markets. Smaller rival Lowe fell 5.2% ahead of its results next week, and Walmart forecast full-year earnings below estimates and painted a grim picture of hotter-than-expected food inflation squeezing profit margins. However, the world's largest retailer recovered from an initial decline to gain 0.8%. The US benchmark 10-year Treasury note hit a fresh 3-month high. Higher yields typically weigh on growth stocks, whose valuations tend to be based on future profits that are discounted heavily as rates go higher. The 10-year Treasury rallied to flirt with 4% for the first time since November the 10th, as investor expectations for a cut this year dwindled and fears grow that the Fed peak level of rates could be higher than expected. The 2-year also went higher and maintains the extreme recession inversion signal. Analysts are expecting earnings of S&P 500 companies to grow about 1.6% in 2023, compared with 4.4% that had been estimated at the start of the year, which underscores what I've been saying about pressure on earnings and so stock prices. And so, as I say, when you get good economic news, that's bad news for markets, and we're going to see more of that ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.